Welcome to episode 25 of the Landlady Boss podcast. I'm here with Kolby Rosemeyer. He is a commercial loan officer, and I've known him for many years, and he handles most of my deals that I have done. So we've done mini projects and properties, so that's been really fantastic. And he has been willing to come meet with me today to hopefully give some advice and options and information to real estate investors out there so you can kind of know what you're dealing with when you do go the commercial loan route working with a bank. So I think Colby's going to have a lot of good information today for us. So how are you doing, Colby?
Hello, I'm doing well. I'm excited to be on here. So thank you for having me on here, and I look forward to the conversation.
Yeah, it's great. Now tell me a little bit about yourself. I think you've been in the banking world for about 15 years.
Yep, that's correct. Yeah, I came in as a teller quite a while ago, back in '06, and then kind of worked up through credit and into commercial and agricultural lending. So kind of made the rounds there. Took a brief stint out in manufacturing for a little bit as a manager, and then came back. I've been back now
Okay.
for a few years, but yeah, a long history in it. So about 15 years total. Yeah.
And you have focused on commercial lending, is that correct?
Yeah, correct. Commercial and agricultural, so on both sides of it, and quite a bit of investment real estate has been a part of that as well. So, yep.
Oh, fantastic. Because I do get a lot of different questions, and a lot of them seem to center around how do I get financing from a bank, or what are they going to look at? Are they going to want to know, my W-2 information when I'm getting a loan for an investment property? Or there's just a lot of lines I think that get blurred with commercial versus residential. I think a lot of people have experience with residential lending just because, they go buy their own house. But when it is in real estate investing, it does kind of take on a different way of getting to the end. So I think that will be helpful for listeners to know just kind of the process. If you could kind of go through what would be maybe the main difference between residential and commercial lending, if you could kind of paint a picture of that for us.
Yeah, so it's kind of interesting, especially when you get into more of the investment real estate side, because ultimately, yeah, you're going through a commercial lender, but it's on normally when you're talking about a single or even 1 to 4 family residence, you're really talking about a residential property. But however, we're going through the commercial department because it's income generating, right? So it's generating rental
Hmm.
income or some type of income from that perspective. So the difference is really there's a lot of rules and regulations that go on either side, but that does make up a big portion of that difference. Now, when we talk about a residential mortgage, it's very common to think about 15-year, 30-year fixed rate type of setup that would be associated with a residential mortgage, where you can go longer amortization. It's your life, right? I mean, that's what you use as your personal asset, the
Right.
biggest, most important purchase that you make potentially of your whole life. So on
Hmm.
that, usually financial institutions will go out to about 30 years on that for sure. So when it comes to commercial, we tend to, at least from our perspective, we stay around that 20-year mark for investment properties, but the setup's similar. Most will also have more of an adjustable rate feature versus fixed rate all the way through. So when you talk about like how the loan is collateralized and everything, it's very similar. It's all about the same. It's a mortgage that's backing the property and the loan itself for the financial institution. So there's some differences, but there's a lot of similarities as well.
Yeah, so usually you can count on, like you're saying, an adjustable rate. I mean, I have heard of fixed rate commercial loans, but I don't think that's as common
Mhm.
because, the bank is trying to make sure that they can still get their money as the market changes and adapts, and it's a little different than a residential loan, which is fairly secure, right? Is it based upon security and risk that the bank is
Yeah,
looking
so
at?
yep, yeah, and you think about that interest rate risk that is held out there in a longer term. You will notice that a lot of the residentials are actually sold on the secondary, but from the perspective of the bank holding a longer interest rate, there's a risk that goes along with that. Yes, that's exactly. And also there are some that will do balloons, but I mean primarily we stick with a fully amortizing here at least. So.
Hmm. Right. And you are a local bank. I guess take a minute and say maybe pros and cons of big national banks versus maybe smaller banks, if you wouldn't mind.
Yeah, so I mean, it's really important to me, and one of the reasons that I really came to Crossroads was the fact that we are a community bank. We're one that's right here in the community. We care about the community. And I'm not saying that the bigger banks don't as well, just from the fact that I was born and raised in this area, and it's important to me to be working with people that I know and that are committed to this community. And it's kind of neat also when you use a financial institution that's local as well, you're also contributing to the fact that they're employing people in the community, they're giving back to the community. So it's more of a partnership when it comes from that perspective. And with the community bank, we look for full banking relationships where we can do not only the loan side but deposit side. You get to know the people that you see on a regular basis in here, and it's just from that perspective, it's near and dear to my heart to be part of a community bank.
Yes, and I obviously enjoy using a local bank versus a huge national bank. I get a lot more one-to-one service. And like you said, when I go in to get a loan for a property in our community, your bank is a lot more vested in making it work because you want to see these properties be in good hands. So I've enjoyed using a local bank, and I would not recommend shying away from maybe a smaller bank at all because I do think you get a little better customer service. So there's my plug for local banks.
Thank you.
But also, so looking at the different financing types available for rental property investors, what would some of the common different loans be?
Well, we stick primarily to the conventional loans. I mean, that's what we will normally do. Now, there's some of the stuff, like say if somebody has an unleveraged property that doesn't have a mortgage backed on it, there is a possibility of doing a mortgage backed line of credit. And I think that's important for some, just from the fact to have quick access to cash. So
Mhm.
sometimes what you'll be able to do is leverage a property that doesn't currently have a loan against it to buy a property really quickly, because we all know if you have cash on hand, that purchase is quick, usually a little bit easier, and then it can be refinanced from there off of that line of credit. So I know that not everyone has that ability to have a free and clear property, but that's one of them that I would say is a little bit more unconventional. I mean, it's still you see it quite a few places, but it's not a fully amortizing term loan. It's just an interest-based loan that allows you to quick access to cash.
Is that like a HELOC or
It's
different?
kind of like that, but the thing is, that's just on the residential side. This is really considered more of just a line of credit, right? It's drawn against it.
Okay.
The features are very similar. It's still going to have a monthly interest payment, but it's just not referred to as the home equity line of credit.
Okay.
It's the
Okay.
line of credit. But yeah, yep.
So that's better if you have a property that's free and clear, owned free and clear, versus leveraging it from the get-go.
Yeah, and that would be like an investment property that's free and clear. If you're doing your home, if you decide to use a HELOC on your home, that's a possibility as well to quick access to cash. But from my side, with the commercial side, it would just be considered a mortgage-backed line of credit.
Oh, okay.
Yep.
Great. So looking at the different types of rental properties, are there different loans for different types, say, multifamily or a single family property or short-term rentals? Does it change or are they conventional loans?
So they're all very similar in how the loan setup would be. It's more about the underwriting, right? Like when we get to the information that we'll need to get behind a purchase. When you have a multifamily, it's obviously going to break out multiple units and your rent roll will look a little bit differently. For the most
Mm,
part, that's going to be about the same as like a single unit property, other than the fact that it's built out over multiple different units. When you're looking at short term, then you have to kind of understand what do you think the lease up's going to be. I mean, cash flow looks a lot differently on a short term. So as we're looking at the underwriting side, that looks a lot different. Now on some commercial properties, the larger ones will look to go a little bit further to 25 years potentially on those. But for the most part, you're still going to be looking at the same type of loan setup. So that doesn't change from our perspective.
okay, yeah, that's really good to know. And is there like a limit if someone comes in, and they say, well, I've got 15 multifamilies and I want to get another rental part? Like, is there a limit that you guys cap it at, or?
So we do have some concentration limits that will be on a single borrower, but we're talking much larger numbers. So that not as much. When you were talking about just say a number of units, there is really no cap for us per se. If the collateral's there and the cash in on the purchase is there, really it's going to come down to just doing the analysis and looking for a decision from there. It's not like I would say, there's a certain number that I just won't do, because that's
Right.
not true. It would really just depend on leverage, right? Leverage and cash flow.
So you're looking, yeah, at the cash flow coming in. So that's kind of the main thing that on a commercial you're looking at, okay, what's the income producing aspect of the property, right?
Yeah, you hear a lot on the retail side about debt to income. Um,
Mm-hmm.
while we use facets of that, we don't only use that index to really determine it. It's more based on cash flow. When we look at cash flow, it would be a DSCR, debt service coverage ratio, is what you'll hear a lot in commercial, and it's just the cash flow divided by the debt service, right? So the annual payments or monthly payments, and then you come up with a ratio of your debt servicing ability. That's something that we utilize. Net worth is a big one, working capital, looking at those numbers. And then on the flip side of that, with collateral, looking at 80% or below is what we kind of look at from there. Now, when I say that, it depends on the situation on where we go with our loan to value, whether it's 75 or 80% loan to value. The
Oh,
key
okay.
numbers that we kind of look at as we're going through our analysis.
Okay, so someone comes in looking for a loan. What sort of things do they need to be prepared to have ready, or what things are you going to look at for them besides, looking at the income for the property?
Yeah, so this is one of the things that I'll shoot out an information request fairly quickly after our conversation. Something I like to have face to face, just because I'm able to help through some of this process. But one of the things is a personal financial statement, going through assets and liabilities and what that looks like from a personal standpoint, as well as any financial statements that would be related to any business entities that a person would have as well. And then 3 years of tax returns is what we would normally request for a new loan request. And then on top of that, would also be kind of an idea of just what are the goals? What are you looking to do? How are you looking to proceed? How fast are you looking to grow? And then a rent roll for your properties as well, understanding how many you have and what that looks like from a cash flow perspective right now. So those are kind of the items that we would really key into. And then a commercial loan application is another one, but that's pretty obvious from that standpoint.
Right, you'd still have to fill out an application for this. Are there any specific loan products tailored to someone maybe getting their first rental property, or would this process be, I mean, you said you'd look at rent roll. Well, if you don't have maybe a rental property yet, how does that process change?
Yeah, so really, when you're jumping into renting, there's some things that we kind of look for. First of all, having the cash available to get to the loan to value. So 20% of the purchase price is what we normally look for, at least on that first property. So having that is a good thing. Having additional income, that's very helpful, from the fact that obviously jumping into one property normally doesn't pay all the bills, right? I mean, it takes a little bit of
Right.
a portfolio buildup to get there. So having that additional cash flow helps. Normally, how we want to look at that initially is that hopefully that loan would be able to be serviced by the other income first, knowing that that income would be more like icing on the cake as you get things started. So
Like
that's kind
their
of how we look.
personal income, you mean like the
Yeah,
W-2?
correct. Yep, W-2 income, or if you had a business or something that was
Hmm.
generating cash flow other than just the rental property.
Right. So maybe don't quit your job and dive all in without any rental properties yet, right?
Yeah, I mean, yeah, it is a little bit more difficult when there's no other income source that would help kind of float the
Right.
boat.
Right. I think a beautiful combination is when you can have either yourself or a partner that is having income coming in, but then one of you has kind of that desire to build up this other area, but investments in real estate, and that kind of works well together because yeah, you still have that income you can show, but you can be working on the real estate side, but yeah, it's helpful to have some income shown. So
Yep.
but as you get more and more and grow your portfolio, then as you said, they look more at your rent roll and the income you have coming in from those properties. So I would think that your your other job or your W-2 would be less important as you get more properties.
Exactly. Yeah. And you're also proving out a model, right? Like you can do this and we know you can do it. We've seen it time and time again. So another thing about relationships that are important, right? Really knowing what you've done and how you've got there and that you're successful in what you're doing.
Yeah, I have heard people say, well, I just shop around for the best rate. And I have wondered how that works out for them because I know, for instance, when I go in and say, hey, I found a property, I want to get this, we have a history, right? You know what I historically have done with properties, you know the rent that comes in, and kind of there's a whole relationship there in history that you can see, okay, we know from experience that she's going to do XYZ with this if we give this to her. How would that work if people jump from rate to rate or bank to bank?
Yeah, so when we talk about one of the big things when we're looking at making a decision is also character, right? So if you don't really know and have a relationship with a potential borrower, a lot of it's built on a quick review of the credit report, right? That's kind of just an idea of, hey, have they made their payments? What does that look like? So, I mean, it's possible, but it's not the same as actually knowing someone. So I think it's important to have it. That doesn't mean that we wouldn't make a decision without having that history, but to your
Right.
point, it's good having that relationship built where it's easy. It makes it easier.
Yeah, you would still be able to look at parameters and lean heavily on that credit report and, their income and cash reserves, all those things you mentioned before. But yeah,
Yep.
it's helpful to build up. So maybe consider for investors, building that relationship. And I mean, it's important to get a good rate and to make sure that, you're not just paying extra fees or unreasonable closing costs and extra interest rates. I mean, who wants to do that? But making sure that you also have that relationship is going to be helpful, I think, as people want to grow. And I have heard people say, well, I was capped at 10 rental properties, or I was capped at, a certain number. And I wonder if are they trying to do like personal loans, or have you ever heard of anything like that when people are capped at the number they can get?
So I would imagine that there is some of that, maybe some places, and it may be the type of lending that they've went through, right? So
Hmm.
I don't have all the history and understanding on what every financial
Right, right.
situation would be, but to your point, maybe that's just something they set as a baseline for that particular financial institution that they just don't want to
Yeah.
jump into anything larger than a certain relationship. And I'm not 100% sure on that, but maybe that's the
Hmm.
situation. Or maybe it's backed by some government funding. I mean, I really don't
Yeah.
100% know on that.
But maybe that's a good question that people could ask if they are shopping around. Do you have a limit on the number of rental properties that you allow? Or, would there be other questions maybe you'd recommend people ask if they're looking at? I'm putting you on the spot on all sorts of things, but my brain's just thinking all these things when you're going into the situation.
Yeah, I think on top of that, one of the things that you should really ask about is the fact on prepayment penalties. So the thing is, like when you
Oh,
look at an overall cost of getting a loan at a bank, it's not only the interest rate, it could be the loan origination fees, it could be on additional fees, but really looking at the full overview of what those costs might be. And from the fact, do you know if you're going to let it term all the way out, or are you going to pay this thing off potentially early because there could be a prepayment penalty that goes along with that as well? So there's a lot of factors, and those are things that you should be really asking questions about to really understand your all-in cost of financing.
that's really good advice. I like that. How can working with maybe a partnership or, joint ventures, does that change anything on the bank's end?
More signatures.
More
No,
signature, more
no,
signatures.
that's right. But really, it's not a bad thing. It's not. I mean, it's not good or bad in and of itself, right? It's one of those things. Yeah, you're able to pool more money together between multiple investors, which is a good thing. So you can take a partnership up on that, and you can also spread the risk where it's not on just one person, right? Which is all
Hmm.
good. And there's also a liability factor that you're able to stay a little bit away from with the LLC or some other type of entity that's established. So all of those things, it doesn't stop us from approving or decisioning a loan. And it really does provide some. We've always said that groupthink is a good thing at times, right? So having multiple investors can make it more difficult to make a purchase, but it can also make it so other people are allowed to or able to ground you a little bit too in decision making. So I don't know. I've seen people that are really, really good at what they do and they do it themselves. And I've seen a group of people that are really, really good at doing what they do and they do it well together. So I think it
Hmm.
just depends on who the person is.
Yeah, you just may have to have a little bit more paperwork. Like you said, if you have an LLC or something, you might need an operating agreement to show the
Yep.
bank and then have everyone on the LLC sign for things. So it might take a little bit more effort on the bank's end to get to closing, but it doesn't really change the nature of the loans necessarily.
Correct. Yeah, I would agree with that. That's, yep.
How do interest rates change from like commercial to residential? Can you usually expect them to be higher in commercial loans than residential?
Uh, yes, traditionally they would be a little bit higher than what you would see on the retail side of it, and a lot of it comes down to the regulations that are held on those sides. It really just standardizes essentially what interest rates you're looking at over all the retail side of
Hmm.
it, where commercial is much more risk-based looking on that. And so you do normally have, and it's usually tied to some type of index that you'll be looking at. So it's good to kind of look at what index they're tying you to and knowing what that margin is. So you really know what potential changes might take place in the future. But really, it's just the bank from the perspective of the interest rate risk that it goes along with tying in long fixed rates. You will notice most of those in-house long fixed rate mortgages, most of them aren't in-house. They're actually sold on the secondary market, which is okay too, and that's fine. They are fixed rate, but the bank's not holding the risk on all of that over that long period of
Oh,
time.
okay.
So just
Okay.
kind of something to put out there on that. So that is a little bit of the difference on how you tie indexes and rates to certain types of loans.
Oh, okay. Are there any difference in time? You said 20 years is typically what you do for a loan for commercial.
Yeah, so on some like say uh if we have say like a big apartment complex and it's in really good shape, we'll look at potentially going out 25 years on that. Um, Now on an investment property, just a 1 to 4 family, we usually try to stick to 20 or less. And I know that at times to try to take a little bit of stress off cash flow, it's better to go longer term on it. But if you really look at breaking down a 15-year versus a 20-year and the interest rate savings, if you can do it in the cash flow that that property provides you, the quicker debt repayment on that, the better on building equity. So that's how we kind of look at it. And I know from
Mhm.
the investor's side, you try to balance that with additional cash flow and being able to buy additional properties. So I get it. It's like we're
Right.
trying to help balance each other out a little bit.
Right. Yeah, you have to kind of decide, okay, do I want more cash flow or do I want to pay down that debt and show greater equity? And there is a bit of a game to a strategy you have to kind of, but it depends on what your goals are, right? Are you really trying to scale and
Exactly.
grow? Or are you trying to pay down what you have so you have more income in the now and in the future? So
Yep.
no one can
It's
answer
not
that
it's
for
not one
anyone.
size fits all. It's not at all.
No,
No.
no.
Yeah.
Now, what do you think are the biggest challenges you kind of see with investors that they face? Just, I'm sure you work with a lot of different ones, and what are the kind of the biggest things that you guys have to deal with?
Some of it is really just, I think the biggest thing I've noticed when somebody comes in and just says, "Hey, I want to buy an investment property, a rental property," and this isn't everyone, but sometimes they'll come in and they'll be like, well, how much will you guys lend? Oh, 80% or 75%. Well, I don't have any cash. Will you guys do 100% financing?" And we're not able to. I mean, we have regulators that obviously keep an eye on what kind of lending we're doing. And
Right.
if we're lending on a property that's at 100% of value and the real estate market changes tomorrow, it's quick to be underwater, right? And so while we hope that would never happen, you still have to be prepared for the worst. So I think really the biggest thing I see on the struggle is having enough liquidity to jump in safely and to be really ready for that.
Right. It's helpful to have a little buffer of your own. People say, how do I get started in real estate investing? I don't have any savings. I don't have any extra and I'm in debt. And I would say maybe take some time to shore up your own financial foundation first and then jump in with a strong base because if, like you said, any shifts in the market happen or, you can't rent your rental or anything that happens or major repairs costs come in, I hate to see people have to, go under because they weren't prepared or they didn't have a big enough buffer. So that's kind of huge.
So it's actually a point that there was this. I had a borrower at one point that purchased a house, and she did it well. She did it at 50% loan to value, and it was thankfully she did that. She probably could have went a little bit higher and kept a little bit higher cash reserve, but the problem was she ended up with a water line issue in her yard, right? Which she ended up having to pay for the excavating, all the fixes,
Hmm.
over $6,000 of that, and that's not in the rent roll, right? I mean, you don't account
No.
for that kind of expense. So luckily, she had the equity in the house to be able to roll that in, which was good to be able to do that. So when we talk about that balance as well, yeah, she could have went a little bit higher, maybe held a little bit of cash versus putting all that in. But at the end of the day, she had the equity that was necessary to take care of the issue. But if you don't account for that and you're lending as much or you're getting as much against the property as possible, and not having any cash set off to the side, it's a recipe for disaster.
Yeah, you're kind of one accident away from something. And you say that a water line or a sewer line, it seems like this year for me is the year of the sewer line breaks. We've had three or
Mhm.
four that there's nothing you can really do besides you got to get an excavator in there, you got to repair. I mean, you can't leave it and say we'll do that later. It has to be
Yeah.
fixed immediately. So, yeah, having a way, reserves, a buffer, equity built up you can pull from something to help you is going to be really key.
Yep.
So good advice. Well, and how would you, we were talking about economic shifts in the market or interest rate changes, and I know a lot of real estate investors get very concerned about that. Like, how would you advise investors to shore up against that or to prepare for that, especially because a lot of the loans have the variable rates that, those changes come.
Yep. Yeah. So, like I said before, know what index you're tied to. You should be keeping a little bit of an eye on that, hopefully. And that's our job too. So, like, if you ever have a question on that, get with your banker because they will answer those questions for you. And then as you get to a rate adjustment, if you don't feel like that's in line with the market, make sure you reach out to them because that's something that I commonly will do as well. If I'm noticing that it's not where I'd be pricing, say, you today, right? I want to have that conversation. I don't want you looking elsewhere. So we'll do what we need to do to keep you here. While it's when I try to talk about stuff like this, it's supposed to be win-win for both of us, right? Like not one-sided.
Right.
So that's what I recommend is as you start to see these interest rate shifts, if you feel like it's outside of what the market is paying for something like that, get with your banker. They should be leading you down the right path. And if you don't feel like they are, talk to somebody that you trust.
Yeah, that's good advice because I know when I've had arms that have come up, we've talked about it and we've discussed, okay, ways, do we want to go this route or that route and kind of talk strategy. So that's once again why it's important, I think, to have a banker that you have a relationship with and that you can trust and that can give you some sound advice because the markets do change and you really have to prepare for that. And maybe having enough equity in it, like leaving, like you said, not leveraging them to the max because that can really leave you in trouble if the market changes and then you don't have enough equity in it. So that that's all good advice. But I thank you so much for your time, Colby. Hopefully, this has been useful for you. If you're enjoying our podcast, please subscribe and share, and feel free to leave a 5-star review. For any questions or comments or topic ideas, please email us at landladybosses@gmail.com. And remember, no one can manage your properties as well as you.